Hey fools, I'm Joel South, and I'm here with Tyler Crow. This is Digging for Value. Hey fools, today we're going to talk about a number of headlines. We're going to start off with some asset sales from Shell, or potential asset sales. We're also going to look at a new natural gas pure player, and then we'll check into some of the offshore drilling fleets. First off, Shell has come out saying they're potentially going to put up some more assets for sale in an area in the United States, Shell play in the Eagle Ford, that have been really one of the plays that have driven a number of companies. So why don't you tell us more of what's going on?
Sure. So, back in the last quarter, Shell was basically saying, we haven't been too satisfied with what's been going on with shale assets, shale development in the United States. So we're going to look to actually unwind a lot of those positions. And we saw one of the big moves in that recently. They're going to be selling off 106,000 acres in the Eagle Ford Shale. Most part, it's a pretty undeveloped asset fleet. They've only got about 150 producing wells in the area right now. And they're also looking to sell about 600,000 acres in the Mississippian Lime, which is even less developed. It only has 45 wells in that area. If you kind of look at the location of them, certainly with the Mississippian Lime, it's been a hard to crack sort of formation. Sand Ridge has kind of been really the only ones to really figure it out. A lot of people have been kind of going away from it, especially in Kansas, where Shell has been kind of working there. So they're going to have a hard time trying to find somebody. But for the Eagle Ford, it's kind of on that border of the condensate and oil window of the Eagle Ford, so it could be some pretty attractive assets for somebody that really wants to come in and get those.
Yeah, sure. In the Eagle Ford, in that liquids play that you were mentioning, in that northern part of the play, there has been a lot of companies trying to go in there and get assets, and the price per acre has really shot up since I would say 2008, 2009, when a lot of people were acquiring their assets in that area. Who would be some companies that might be on your target that would want to jump in and get some of these assets?
So I think three companies that I think could actually make it work, and probably in a really good position to do that right now, are Chevron, Apache, and ConocoPhillips. And there's two things that kind of bring both of these companies together in that sense. Is number one, they all have boatloads of cash. Obviously, Chevron, they're sitting about $28 billion of cash just from their operations, but Apache and ConocoPhillips have just completed some very large sales. Apache just finished their sale of to a private company for its Gulf of Mexico assets, and Conoco's been kind of doing that asset shuffle recently. So they've got a lot of cash on their books, and they're probably going to be looking to make a buy so they don't have to pay a lot of taxes on those sales. So those two, and then also all three companies have had stated management goals to grow U.S. production, especially in oil. ConocoPhillips and Apache have kind of had some success growing assets, where recently they had been struggling on a little international place. So looking at this, it looks like I think these three companies could really benefit going into the Eagle Ford, into this new formation.
Our next headline is from Bloomberg. It's Antero Resources, this company that is currently private. It's a pure natural gas player, which, with natural gas prices maybe slowly climbing up, is very interesting. So why don't you tell us about this company and what's going on?
Sure. So it's going to be public, but not a whole lot of public. It's still going to be mostly privately owned. They're only going to actually float about 11.8% of the company on the equity market. It's going to be trading on the New York Stock Exchange as AR. Its plans to raise about $1.626 billion in this IPO to help fund a lot of the development that they're doing in the Marcellus and the Utica, which is where all of their assets currently are.
Okay, that's interesting. If you look at just pure natural gas players right now, you've seen a lot of pure players move into the liquid side when natural gas prices plummeted. Not a whole lot stayed around. Really, the only ones that did are the low-cost natural gas producers. Is this company one of those low-cost natural gas producers? And who could you compare them to that are traded on the markets today?
Sure. So if you go back and you look into their S1 filings that they just did for this IPO, it does look like they are going to be one of the lower cost producers in that kind of pure natural gas play. They're currently producing at about $3 per 1,000 cubic feet at a break-even cost, which really puts them in line with a lot of those low-cost producers we've talked about. Companies like Ultra Petroleum and Southwestern, both of those guys are looking at somewhere in that $3 range, which makes it pretty productive for these companies. But I think one thing that actually makes Antero a little bit more attractive is, even though they're a pure natural gas play, they do have a very strong natural gas liquids position in both the Marcellus and the Utica. So not only are they looking at being a low-cost producer, but they're also getting a little bit higher margin on it, on getting some of those like liquid petroleum gas and some of those other liquids that are coming out in their areas. And also, they have a pretty good, I guess you could say, asset base. They're right now proved probable and possible reserves for the company is at 19.8 trillion cubic feet equivalent. So it's a pretty good asset base to work off for a while.
Very interesting. Let's move into our next segment. Our next segment is the buy, sell, hold. I'm going to give you 3 companies in the offshore drilling market. I want you to tell me what company you really like, which one has potential but you're not sure if you could pull the trigger today, and which one you're going to stay away from. So 3 companies I'm going to give you is Ensco, Diamond Offshore Drilling, and Seadrill. So why don't you tell us which one you would buy right now?
I think for me, and maybe a little bit of surprise to a lot of people who are watching this, it's actually going to be Ensco. One of the reasons that I'm looking at them right now is they have an ambitious expansion program, but at the same time they're doing it more within their cash flow versus somebody like a Seadrill who is kind of levering up with debt to make their expansion happen. So with Ensco, they're not needing to take on that big debt position. And at the same time, Ensco has a lot of those qualities that Seadrill has. They're just kind of flying under the radar a little bit more. They've got the young floater fleet. They've got a lot of jackups or high specs for harsh conditions, such as what we're seeing in Norway, a lot of the North Sea operations. And one thing I do really like about Ensco is they have a standardization program, which means that there's going to be the maintenance turnarounds for the company is going to be a lot faster, means more time making money for the company, more day rates, a lot of less utilization times. And one of the things that may be a downside for Ensco is they do have more exposure to the jackup market, but these new builds are going to be high-spec rigs, and they're going to be higher margins because they're going to be working in those more harsh environments. Excuse me. And why I really like them right now in comparison to Seadrill is because they're cheap. Day rates for a lot of these companies are relatively predictable, and so you can kind of project earnings for these companies pretty well, and they have a forward PE of about 7.9 compared to the Seadrill, which is right around 13. So at that price, it's really hard to turn them down.
Okay, let's get into the next, the one that you think could have potential. Who are you looking at there?
Well, I don't know if they could have potential. They definitely have potential, and that's Seadrill. They are, one of the best in the business, especially in that deep, ultra-deep water region. They're about to double their fleet between now and 2016 on both floaters and in the jackup rigs, and they do have a very, very strong backlog. They've got about just under 50% of their entire fleet is actually backlogged all the way to 2016. And so there's a lot of things I really like about Seadrill right now. But the one thing that makes me, I guess you could say, hesitant, or at least why I would pick somebody like Ensco first, is just because I think the market is a little bit more in tune with what Seadrill wants to do going forward. Like I said, they have a forward PE of about 13 compared to Ensco with that 7.9. It seems to me like you could get a little bit more bang for your buck out of Ensco right now.
It's a very interesting, one of them is an older, bigger company where Seadrill might have a higher PE with some of the growth potential they have. And don't forget that the dividend that they have is significantly higher than what you can get there. But like you said, you can't really go wrong with Ensco. They are one of the customer satisfaction or customer favorites in the industry. So that leaves us last with the company that you would most likely sell, Diamond Offshore. What don't you like about this company?
To me, it just seems like Diamond Offshore is just kind of stuck in this no man's land in terms of the rig operations or rig manager industry right now. 40% of their fleet is in the aging midwater floater fleet, and it's kind of a dying market right now. We're seeing it relatively flooded. The day rates for that are going down while everybody's really trying to get into ultra deep shore because we got a lot of things coming online, like the pre-salt formation in Brazil is just going to have its auction, so there's going to be a lot of activity going on there. We've seen a lot of activity on offshore Africa as well as in the Gulf of Mexico. So that midwater floater just doesn't seem that attractive right now. And you look at Diamond, their utilization rate has been slipping. Right now, it's about 77% for its fleet, which is adjusted for new builds, not even including those. And when you compare it to somebody like Ensco or Seadrill, who are consistently running 95% or better, it just doesn't look as attractive. Mm-hmm. And Diamond, at the same time, you've seen some of the other older companies, like both Transocean and Noble Energy, are either looking to spin off or sell their aging fleets. Well, Diamond has kind of been holding on to them, kind of sticking to their guns in the game. And so I just don't see long-term that they're making enough moves to compete with these expanding fleets going forward.
Very interesting. I agree with you on Diamond Offshore. I'm not sure if I would put Ensco ahead of Seadrill. However, I think they are two of the better drillers in the space. So thanks a lot for that. And next, our last segment that we want to look at is looking forward, who I guess is on your radar? What's a company that you think is a good value today?
Well, I think it's right now one company I'm taking a deeper look at is Chesapeake Energy. And why I say that is I think there's a lot of signs that the company is coming back. Just a little while ago, they announced that all of their 2014 capital obligations are going to be met with cash flow. So there's not going to be any more asset sales necessary to meet any obligations, which is a kind of a critical point. Doesn't mean that they're not going to sell anything anymore. They might just to reduce debt even further.
Sure.
But they're basically saying we don't need to sell anything ever again, if they choose not to, which is very, very attractive. And 2013 is their capital expenditures are expected to be 46% less than they were in 2012. But if you look at it, back in 2012, 66% of their capital expenditures were only dedicated to putting the drill bit in the ground, actual drilling and completion costs. But now in 2013, that's going to be 81%. They're not just spending money to keep a foot on a leasehold, which is very attractive for them. It means that we're going to see much better return on those capital expenditures going forward.
Yeah, definitely. I like that a lot of companies are moving away from that held by production. We're going out and just trying to lock up your assets and drilling. Chesapeake and Sandridge are two companies that, in their prospective place, have really hurt themselves over the long term, and now they're finally to that position where they're starting to correct things. And the stock market over that time really punished these companies. They both plummeted mightily, especially with natural gas prices, since they were both natural gas heavy coming into 2009. So with that said, with the assets still in place, new management, who I think is great with CEO Lawler coming in, do you still see this company as an undervalued investment? I
do. If you kind of look at their books right now, back in 2012, they had to move a lot of their assets off the books because of natural gas pricing, which means it's kind of hiding underneath the books there. So if somebody's really looking at them, it might not look as attractive as it really is. One of the concerns with them is kind of actually looking at the gas prices they're getting right now. In the second quarter, they had natural gas realization prices of $2.62, which doesn't look that great considering Henry Hub spot prices right now are $3.60. So they're actually going to improve their hedging position on their recent quarterly filings. They're going to be bringing on for the rest of the year hedges at $3.70 or higher, which will get better natural gas prices and should also help to boost earnings there. So overall, there are still some concerns with Chesapeake, but they're making the right moves, and it just seems to me that investors should really take another look at this company.
Yeah, definitely, I agree. It's a company that's been trading under their net asset value for quite some time, and if you see that natural gas prices start really climbing up, even to the mid-4 levels, and with all their capital expenditures really focusing on their oil plays and liquids plays, this company, I think, has a great future, really separating what they did in the past, not only by moving their business forward and focusing that way, but also really eliminating a lot of the C-suite and managers that they had in place with a lot of layoffs. So really interesting to see what this company will do long term. So Tyler, thanks a lot for your insight. Thanks a lot for stopping by on today's Digging for Value. We'll see you next week, and Fool On.